Silver just punched through $110, not someday, not in a rumor, right now. And here's the part nobody wants to say out loud. This isn't a normal rally anymore. This is a market alarm, because the story is no longer silver versus gold. The story is physical silver versus the entire paper system built on it. If you think $110 is the finish line, you're looking at the wrong number. The real breakout is happening under the hood, in inventory and delivery, and in industrial demand that doesn't care about price. So the question for 2026 is simple. Is $200 the next stop, or is that just moonshot hype? Let's run the data, calmly, mechanically, no drama, just math. First, the velocity is the headline. Silver is up more than 40% in the first 26 days of 2026, on top of a massive 147% move in 2025. That is not a trade. That is a repricing event. Markets do not move like that unless something structural changed, and the structural change is this. Silver has been reclassified quietly by big money as a strategic industrial asset. Not a collectible, not a shiny hedge, a metal the modern world literally burns through. Now let's talk about the signal that set off the alarm. This month, nearly 26% of COMEX registered silver vanished in a single week. Read that again. Registered. The deliverable pile. In other words, the portion that's supposed to be ready when someone says, "Great, I'll take the metal." And suddenly, a huge chunk is gone. That's not a normal day on an exchange. That's the market admitting people aren't just trading price anymore. They want the thing. Here's how you know this is physical. The spot screen may flash 110, but the street price, the real-world price for 10Z coins and bars, is hitting $135 to $140 in some regions. That is not a small premium. That is a stress fracture. It's the difference between I own exposure and I own ounces. When premiums explode like that, the market is telling you the bottleneck isn't buyers. The bottleneck is supply. Now we get to the engine of this move. The 5-year deficit has turned into a 6-year deficit. We are consuming silver faster than the world can mine it. And unlike a lot of commodities, silver is not always recovered. In the industrial world, silver gets used, dispersed, embedded, and lost. It becomes tiny traces inside electronics, panels, connectors, and circuitry. That silver doesn't come back easily. It disappears. Solar PV alone is a monster here. AI infrastructure is the other. Data centers, power systems, high-efficiency electronics. They don't care if silver is 110 or 210. They care if they can get it on time. This is why the poor man's gold label just died. Silver is behaving like a strategic input. Now the uncomfortable part. For every 1 ounce of physical silver, there are hundreds of paper claims. Futures, swaps, ETFs, unallocated accounts. Promises stacked on promises. That structure works only under one assumption. Most people will never ask for delivery at the same time. But when industrial giants demand metal, and retail investors chase physical because premiums are screaming, that assumption breaks. So what happens? The paper market starts to wobble. Spreads widen. Inventories drain, and price doesn't move in a smooth line. It gaps, it spikes, it snaps back $10, then rips $15, because the market is trying to locate supply that isn't there. Okay? $200, is it possible? Yes. Is it guaranteed? No. But the math can't be ignored. Here are 3 realistic paths that put $200 on the table in 2026. Path A, deficit plus panic pricing. If the deficit stays near a couple 100 million ounces and delivery pressure keeps draining the ready inventory, the market eventually prices silver like a scarce industrial feedstock, not like a sleepy, precious metal. When that mental model flips, prices don't rise politely. They jump to a new bracket. Path B, ratio compression. Historically, the gold to silver ratio lived closer to 15.1. We just compressed from about 80.1 to around 45.1. If gold holds near $5,000 and the ratio continues tightening, you don't need a miracle to get silver into the $200 zone. You just need the ratio to keep doing what it's already doing. Path C, the no substitute bid in jewelry. You can delay buying. In industrial production, you cannot. If silver is on the critical path for AI and power infrastructure, the buyer with a deadline becomes the buyer who sets the price. Deadlines create panic bids. Panic bids create moonshots. Now listen carefully, because this is where most people lose money. Silver is famous for one thing. It rewards patience and punishes leverage. On the way to a higher target, silver can drop $10, $20 in a heartbeat. Not because the thesis died, because the market is thin, emotional, and easily shaken. So if you're watching this and thinking, I'm going all in right now, slow down. Rule 1, don't use money you can't afford to lock up. Rule 2, don't confuse a squeeze with a straight line. Rule 3, if you're buying physical, understand premiums and spreads. Rule 4, if you're trading paper, respect stop losses and volatility. This is not a sleepy market. It's a fight. If you want to stay grounded while everyone else panics, watch 4 things. COMEX registered inventory, not total. Physical premiums on coins, bars, especially if they keep climbing. The gold-silver ratio, because it shows who is leading. Industrial headlines, solar, data centers, and any supply chain delays. And here's the mindset. You are not chasing a number. You are tracking a system under strain. $110 was the siren. $200 is the question. The answer will be written in delivery data and real-world shortages. So, comment one word, Moonshot or Mirage. And if you want the next update the moment the numbers change, subscribe. Because in a market like this, the chart can move faster than the news can explain it. Stay sharp, stay patient, and don't ignore the alarm. Here's what most people miss. Silver supply can't respond quickly. A copper mine can decide to run more ore tomorrow. Silver, often it's a byproduct, pulled out while mining copper, lead, zinc. So even if silver doubles, many producers can't just flip a switch and double output. Permits, processing, grades, energy costs. This is a slow machine. Recycling helps, but it has limits. Scrap supply rises when prices rise, sure, but industrial silver isn't sitting in neat piles. It's scattered inside devices, solder points, films, micro layers. Recovering it is expensive, slow, and sometimes not worth it. So the recycle wave everyone expects tends to arrive late. And then there's the distribution shock. As of January 1st, 2026, China's export licensing rules tightened the flow of refined metal. Call it compliance, call it paperwork, call it bottlenecks. The result is the same. Less metal moves, slower, and with more friction. Some estimates put the hit to global availability around 60% in the short run. This isn't a headline that screams crash. It's a change that whispers delay. And delays are deadly when manufacturers run on just-in-time inventory. Let's zoom in on the 2 demand engines. Solar PV is not a luxury, it's a global build-out. Every panel uses silver in its conductive paste. Yes, the industry thrifts, it tries to reduce silver per cell, but the growth in total installations can still overwhelm efficiency gains. AI data centers are the other silent vacuum. Think of it like this. To build the digital world, you need an analog backbone. Power distribution, high reliability connectors, switchgear, cooling controls. All of it needs conductivity, durability, and low failure rates, and silver sits in the parts you don't get to cheap out on. So while investors argue about valuation, industrial buyers argue about delivery dates. And that's why silver behaves like a strategic metal, because in this decade, it is one. The physical premium isn't just a number, it's a process. Step 1, spot rises. Step 2, retail demand wakes up. Step 3, mints and refiners hit capacity limits. Step 4, dealers start quoting when available, not in stock. Step 5, the premium becomes a rationing tool. That's how you get $110 on the screen and $140 at the counter. And once that gap stays open long enough, something else happens. Arbitrage breaks. Normally, big players would buy the cheaper venue and sell the expensive one. But if you can't source physical, you can't close the loop. So the gap becomes the new normal until the paper price is forced to chase it. Quick translation. COMEX has eligible silver and registered silver. Eligible is metal sitting in a vault that meets specs, but it's not promised to anyone. Registered is the pile tagged and ready for delivery. When registered drains, it's not just a line on a chart. It's the market's ready inventory being consumed. So when you hear 26% of registered disappeared, that's a warehouse manager saying, those bars just got assigned to someone who insisted on taking them. This is why delivery matters more than price. Price is a scoreboard. Delivery is the game. Let's do the simple math on camera, the way a calm engineer would. If gold is $5,000 and the ratio is 45.1, silver implied price is $5,000, 45 IFRs about $111. That's basically where we are right now, which means the market is already telling you silver is leading. Now imagine the ratio compresses to 30.1 while gold stays the same. 5,000, 30, 166, compressed to 25.1, 5,000, 25 to $200. That's it. No fantasy, no conspiracy, no magic, just ratio compression in a tight market. And if the ratio ever revisits 21 with gold unchanged, $5,000, $20, $250. This is why people are whispering moonshot, because the arithmetic stops sounding crazy once the ratio starts moving. Silver doesn't trend like a stock. It sleeps, then it sprints. In past cycles, silver often lags, then overshoots. It breaks levels violently, makes headlines, scares people out, then comes back for a deeper breath before the next leg. So if you're looking for smooth, silver will disappoint you. If you're prepared for chaos, silver will make sense. Let's be fair. What could cool this off? A sudden surge in available inventory, real metal, not promises, a major demand slowdown in solar or high-end electronics, A lasting collapse in premiums, meaning retail stress is gone. A reversal in ratio compression, where silver stops leading. If those happen, the market alarm quiets down. But notice something. Most of those require time, and time is exactly what a shortage market doesn't give you. Here's a mindset shift that protects you. Don't anchor to one price target, anchor to conditions. In a shortage, the question is not what is silver worth, the question is who needs it and how soon. If a manufacturer needs silver by Friday, they don't negotiate like an investor. They bid like someone trying to keep a factory running. That is what changes the entire price discovery process. Also, separate owning from trading. Owning is slow, patient, and boring. Trading is fast, emotional, and full of traps. If you mix them up, you get wrecked. If you keep them separate, you stay calm. This is educational, not financial advice. Do your own research. Manage your risk. Right now, the market is giving you two prices, a paper price and a physical price. When those two prices fight, volatility is guaranteed. The alarm isn't telling you to panic, it's telling you to pay attention. Because once the world realizes silver is not optional, the price doesn't ask permission. It just moves. If this really is a squeeze phase, the tape will start acting weird. You'll see rallies that happen in minutes, not days. You'll see quiet sessions that suddenly rip $4, then dump $6, then recover. You'll see spreads widen in places you never cared about before, and you'll see one repeating pattern, buyers stepping in faster after every dip. Watch for headline moments like a big delivery notice, a major refiner delay, a surge in retail back orders, a sudden jump in leasing, borrowing costs. None of these are politics, they're plumbing, and plumbing is where squeezes are born. One last thing, if you're waiting for everyone to agree before you act, you'll be late. By the time the story feels safe, the move is already done. So don't chase, track, don't panic, plan. I'll keep updating the numbers as the market prints them, because in 2026, silver doesn't whisper anymore. It screams. $110 was the headline. Registered inventory was the warning. Physical premiums were the proof, and the ratio is the roadmap. If the shortage stays real, $200 isn't a meme, it's a waypoint. See you in the next update. Hit like for daily inventory checks, and drop your city in the comments. I'll track where premiums are exploding first. Subscribe. The alarm is still on. Stay.